Hi everyone, this will be our supply, demand, and international trade lecture. This will also focus on the gains from trade as well as protectionism policies. Starting off, we want to be thinking about the effect of imports on the economy. So first we're going to have our domestic demand curve. Domestic demand is simply referring to the relationship between the quantity of the good demanded and price for the domestic consumers. We will also have the domestic supply curve, again, only looking at domestic producers, and we'll see that relationship between quantity supplied and price. We're also on our graph going to include the world price. If we're looking at international trade, we need to look at the difference between what domestic prices are and world prices, as this will help us determine our flow of trade. So this will be the effects of imports. Anytime that we have imports, when our market is open for trade, we're going to see that the actions of the producers that are exporting goods out, or the consumers that are importing goods in, that it's going to drive the domestic price closer to the world price. So we see the two prices getting closer together over time. Whenever we have the world price lower than the autarky price, then we're going to see that it will naturally lead to imports. Logically, this should make sense. If consumers can buy goods at a cheaper price from abroad, they are likely to buy those goods abroad, import them in. Okay? And we're going to see that we're going to have a fall in the domestic price as the domestic producers try to be more competitive with their international competition. Remember that autarky refers to a situation with no trade. We see that there will be winners and losers. There's always winners and losers, but the overall gains from the winners outweigh the losses from the losers. With imports, when our world price is below our autarky price, we see that consumers will gain and that the producers will lose. Okay? But again, collectively, the consumer gains are greater than the collective losses on the producer side. Here we have consumer and producer surplus in autarky for auto parts. So our price is on the vertical, quantities on the horizontal. We have our downward sloping demand curve. Remember, that's the law of demand, the inverse relationship between price and quantity demanded. We have our upward sloping supply curve, that positive relationship between price and quantity supplied, referred to as the law of supply. We have equilibrium labeled with point A for autarky when we're not trading. And then we have PA for our price with autarky and QA our quantity, both equilibrium price and equilibrium quantity. You can see here that we have a blue shaded and a pink shaded area. Now, consumer surplus is an economic term that is covered in the microeconomics course, Econ 4. If you haven't taken micro yet, that's okay. If you have a deeper understanding of what's happening here. Consumer surplus essentially is the satisfaction that consumers get when they're able to buy a good for less than what they're willing to spend. So when you go to the mall and you need a new pair of jeans and you say in your mind, I'm willing to spend $100, and you get to the mall and your favorite pair of pants is only $75, you would earn $25 of consumer surplus. It's your satisfaction from buying something at a price lower than what you actually pay. Now, producer surplus is in the pink shaded area. Again, it's covered in micro. So if you've taken micro, you should remember this. If you haven't taken micro, that's fine. You will probably at some point get there, and then this will make more sense. But the short story is that just like consumers, producers get satisfaction from selling things at a point higher than what they're willing to. Okay, so some producers are willing to sell things at a lower price, but they're able to sell at a higher price. It would be like the clothing manufacturer being willing to sell the pair of jeans for $50, yet you actually bought them at $75. So therefore, the producer gets that satisfaction, that surplus from being able to sell the good at a higher price than what they were willing to sell at. Here we're going to add in what happens when we have the world price below the autarky price. So same graph, the only thing I've done is I've made the autarky price a solid line and I've removed the shaded areas of surplus. Here we go. Our world price is below the autarky price. So I'm going to back it up so you can see it happen one more time. When our world price is below, we're going to have a difference between quantity supplied and quantity demanded domestically. Okay, so our world price is below. This is going to lead to imports. Notice that we have a dot along the red line. The red line is the domestic supply curve, and that dot, when you follow the reference line down, says QS, quantity supplied domestically. That's how much firms in the United States, if we're looking at trade in our country, that's how much producers within the country will produce at that lower price point. Now, if you follow the world price all the way over to the blue domestic demand curve, there's a dot there. The reference line down is quantity demanded. That is domestic from domestic consumers at that lower price. They're willing and able to purchase more. The difference between quantity supplied and quantity demanded is fulfilled by imports. So instead of having a shortage of goods, since supply is less than our demand, quantity supplied and quantity demanded, we fill in that gap with imports coming in from abroad. Now, what happens on surplus? Same graph I had before. Okay, so it's just a little bit more clean. There's less lines here. And I have in our changes in surplus, our gains and our loss relative to consumer and producer surplus being measured by surplus. Now, before we had international trade, consumer surplus was area W. After international trade, that world price is lower. Now international trade allows for consumers to enjoy areas W, X, and Z. Consumer surplus on a graph is the area above price below the demand curve from 0 all the way over to Q, the quantity. If you've taken micro, it's back there. You know this. It's somewhere in your head. If you haven't taken micro, don't worry. I'm not going to test you on it, but it's a nice visual way to see how trade leads to this idea of winners and losers because we're measuring the gains from trade based on surplus. Before international trade, producer surplus was area X and Y, the area below price, above supply from 0 to Q. Once international trade occurs, producer surplus shrinks and they no longer have area X. Producer surplus is only area Y. So we can see here that we've had the gains from the winners, consumers in this case, because they're enjoying more product at a lower price, outweigh the losses of the losers, the producers, that are the losers because they're selling less product and at a lower price. Okay. Let's flip this around and look at exports. Okay. If the world price is greater than the autarky price, then we're going to have trade leading to exports. This will push our world price, it will decrease the domestic price compared to the world price. Okay. Again, we have gains from trade. This time, the collective gains from the producers outweigh the losses from the losers, and the losers this time are the consumers. Okay. We start off with our graph. This time I'm looking at airplanes. This is something that we actually do produce in the United States. Boeing is a very large company within the United States, and it is one of our top exports with the aircraft, airplanes, and helicopters. Price on the vertical, quantity on the horizontal, upward sloping supply, downward sloping demand, and our Autarky price drawn as the solid line. Okay. When the world price is greater than our Autarky price, this is going to lead to exports. Our world price is labeled PW, the lines drawn all the way across. You notice two black dots. One dot when we cross the blue domestic demand curve. The reference line down is labeled QD, and it's showing domestic quantity demanded. How much would be demanded domestically for this good? The second black dot is on the red domestic supply curve. The reference line down is labeled domestic quantity supplied. That's showing how much firms would be willing to produce and supply in the market domestically. In this case, we don't have a surplus since our quantity supplied is greater than quantity demanded. We just simply export out these additional goods that are being produced. Again, I have the same graph. We're just going to measure the gains from trade looking at surplus, or being measured by surplus. Okay. My graph here is the same, like I said, it's just less labels in order to keep things a little bit more clean. Before international trade, consumer surplus was areas W and X, above price, below demand. Producer surplus was area Y, below price, above supply. When we engage in trade, in this case, when we have exports, the price increases up to the world price. Therefore, consumers are the losers. They're paying a higher price and getting less quantity. Therefore, they lose out on area X, and consumer surplus is only area W. Producer surplus before trade was only area Y. With trade, the price increased and quantity increased. Therefore, producers picked up area X and Z because producer surplus is X, Z, and Y, all of it below price, above supply. Therefore, it measured by surplus, producers are the winners. They have more to gain. The gains to the winners are greater than the losses of the losers being the consumers. Now, let's look at trade protection. When we have free trade, it means the government is not trying to get involved in the market. They're not trying to change around the level of exports or imports. They're just letting the market be as it is. Anytime we have any policy to limit the amount of imports into the economy, or we could even look at this from an export side, so it can go both ways, but mostly we think about trade protection and protectionism, looking at limiting imports. Okay. Most economists argue and advocate for free trade. Anytime we have the government getting involved with trade protection policy, we end up seeing some consequences that are not beneficial to the economy as a collective whole. We will look at tariffs. This also works on import quotas, although I'm not going to go through the quota example here. And sometimes the government will even do subsidies for export industries. I'm not covering that here. We're just going to look at tariffs to get started with. Okay. Tariff very simply is a tax. It's a tax on a good that comes in when it's imported into the country. If we have a tariff, it makes the domestic price, or it's going to raise the domestic price above the world price, leading to a fall in trade and total consumption and a rise in domestic production. Remember, the idea of protectionism is to protect the domestic industry. And by having the tax come in on the imports, we're allowing for this domestic production to be protected. Okay. The producers are going to gain, and the government gains because they're collecting a tax. This is a form of tax revenue that comes into the government. Right? Consumers are going to lose, and we're also going to see something called deadweight loss. If you've taken micro, you should know about deadweight loss. Deadweight loss, very simply, is the loss in surplus due to a reduction in transactions. If you have not taken micro, don't worry. These are just extra econ terms to add in. Here is our graph before the tariff. The world price is below the autarky price. I did not include the autarky line because I wanted to keep this diagram a little bit more clean. But we already went through it, so looking at this graph, it should make sense. We know when the world price is below the autarky or the equilibrium price, that quantity supplied domestically is going to be smaller than quantity demanded domestically. That gap between quantity supplied and quantity demanded is filled with imports. When we have a tax on the imported goods, it's going to push the price up. Now, it's not pushing it up to equilibrium, the autarky price, and it's not pushing it above equilibrium. This is happening in between. So you notice that the tariff is labeled PT, the price of the tariff, and that's happening below the autarky or equilibrium point. Now, the price of the tariff, I have the solid line across, I have the two dots, and when you have the dot on the red domestic supply line, you draw the reference line down, that's QST, quantity supplied domestically with the tariff. We also have QDT, quantity demanded domestically with the tariff. We still have imports with a tariff. Okay, so it's not that imports are going away, we just have smaller amount of imports compared to what we had before the tariff. So you can see how that bracket is smaller. Now let's look at surplus and what's happened here. We know that when we had international trade, when we were able to consume more at that lower world price, that we had a amount of international, or we had consumer surplus was the area above that world price below demand. This chart here is just showing our change. So what we lose out on as consumers is we no longer are enjoying areas A, B, C, and D, because consumer surplus is the area above price, in this case PT, below the blue demand curve. So it's the upper white triangle. It's not labeled in this case, but originally it was from PW all the way over to the blue demand curve and that larger triangle. It's just decreased. Now, producers are gaining here. They gain by letter A. Before the tariff, they had that very tiny triangle PW, below PW above the red supply curve. Okay? And it's that small triangle, it's white again, very tiny. With the tariff, the price goes up to PT, so producer surplus is the area above, I'm saying it wrong, below the price above supply. So now it's a larger triangle. They pick up area A. But now we have a third winner here, or a third participant that we had before. Consumers are the losers, producers are the winners, and then government picks up area C. Area C is the amount of tax revenue that comes from the tariff. If the tariff is $5 a unit and there's 100 units being imported in, then they're making $500 or $5 million if it's a larger quantity product. So they are a winner in terms of overall changes in surplus. Now, we lose out on areas B and D. That's the idea of the dead weight loss. We lose out on those transactions. If we're thinking about trade protection, why do we have it? Advocates of trade and of tariffs and import quota have three main arguments. Those typically include national security, job creation, and the infant industry argument. Okay? Even though we have deadweight loss, so even though we have loss that happens, we lose out on transactions, we have to think about the political side of this. The losers of trade are producers. Producers are often a small group and they're very cohesive. They can lobby, they can have more clout in political areas to protect and to have policies go through to protect their domestic industry. Consumers as a collective whole, we're not organized people. Getting all of us organized to be able to say no tariffs because it's going to cause the price to go up and the quantity to go down is much more difficult. But when a small group is being hurt, it's a lot easier for them to coordinate and to change policy that protects their industry. Okay, I hope this helped with our gains from trade. Let me know if you have any questions.